Good morning, guys.
Good morning.
Morning, how are you?
Good, surviving.
All right, that's fine. So meet again this morning. We just want to go through a couple of questions for business finance for preparation for our exam. So just like we did on Tuesday, I'm not gonna go deep into most of the questions. I'm just gonna do surface level and just highlight a couple of things so that at least you just have a general feel of what you were supposed to do. That way we can at least do most of the questions, because if I go too deep into it, we might not even end up doing anything, right? So I'm just touching on the surface level so that at least you have a general feel of how you were supposed to address the particular questions in this particular exam. All right, so let's start trying to open a Word document here. Okay, so I sent you guys the exam paper that we are doing. It's the one that says 26 November 2021. All right. So question number one for the paper was a theory question. All right. Part of it was a theory question, and then part of it were some calculations, right? So now question one. All right. So 1.1 says here, Shapiro Wholesalers offers Umhlanga trade terms of 30 days, but the wholesaler will allow a discount of 2% if the discount is settled within a period of 12 days. Right, using the information to determine the cost of Umhlanga as a percentage of not accepting the cash discount. So this one, if you check in your unit number 3, you will find the formula for this, right? So applying that formula to the question is going to be 2%. 2% divided by, can you guys see this? It's going to be 2% divided by 100% minus 2%, all over, we multiply everything there, multiply by 300 and, what does your lecturer use? Is it 360 or 365? Let's just double check that.
It's 360 days.
360. Okay. Number 3, it's unit number 3. I should have the formula somewhere in there. Is it? All right, fine. 360 divided by, it's what? 30 days. 30 minus 20. And we close our brackets and we multiply everything by 100 because it's a percentage, right? And we put all of that in a calculator. Put all of that in a calculator. That's 2 divided by 100 minus 2. That gives you 0.0204 multiplied by.
Sorry, James.
Yes.
Is it not 30 days minus 12 days?
Oh, sorry. Don't know why I wrote 20. Probably another question that I was doing 12. Right. Thank you for that. All right. Okay. So 360 divided by 30 minus 12. That gives you, interesting, 20. Okay, multiply by 100. 360 divided by 30 minus 12, 20. Okay, it's fine. So probably that's where I was getting my 20 from. All right, 0.4 multiplied by 20, multiplied by 100. And then we get 40.8%. Right. So generally, you're just applying the formula. So you should check for it in the unit number 3.
Sorry, James, where are you getting the 20 from? I'm confused there.
360 divided by 30 minus 20. What do you get?
Oh, okay. Sorry, my overall answer was 26.23.
Okay. Is the 360 correct? Did you use 360?
So I got that.
Yes. So,
I also got that.
all right. So 360 divided by 30 minus 12. What did you get for that?
I'm just reworking it out. Sorry. Times 360 divided by 30 minus 12 minus 11. No, something's wrong. Sorry, you continue. I'll try and work it out.
All right. Sure.
Thank you.
All right. Cool. All right. So we go to 1.2. So that's 1.1, right? So it's just an issue of applying the formula, right? So identify where the formula is in your study guide and then apply the formula as provided by your what? By your lecturer, right? We go to 1.2. 1.2, same thing again. It's from unit number 3. You're just supposed to apply the formula, right? So this one is economic order quantity, and you're given some information on economic order quantity. So again, if you go to unit number 3, you search for the formula for economic order quantity, right? And then you apply the formula for there it is. Equal Q is equals to 2 multiplied by the ordering cost multiplied by the annual sales divided by the carrying cost. All of that, you get the square root of it, right? So
Sorry.
formula. All right. So let's see. EOQ is going to be equals to the square root all right. Square root of what? The annual sales is 60,000. 2 multiplied by 60,000. 1, 2, 3. Multiplied by the ordering cost. What was the ordering cost? 2 rand per order. All of that divided by the holding cost. What is our carrying cost? 10%. So it's 0.1 multiplied by what? 10% of what? 10% of the purchase price is 30 per unit. 10% of 30. Right? And then we close the bracket. E or Q is going to be equals to the square root of. Now we'll put that in a calculator. So 2 multiplied by 60,000 multiplied by 2 gives you 240,000. 240,000 divided by 0.1 multiplied by 30 rand gives you 3. Close bracket. EOQ was to square root. Right, 240 divided by 3, 80,000. So square root of 80,000 is our answer. The square root of 80,000. So you put in a calculator and you get the square root of 80,000. That's 282. I get 282.84 units. Then you can round up your answer if you want. You can round up your answer to 283 units as your final answer, right? So that's 1.2 there. Then 1.3, it's another theory question. So 1.3 says, use the examples discussed the main users of financial statements. So I'm sure this one should be either in unit number 1 or unit number 2. All right. So theory questions, like I said, just go into the study guide. Don't waste most of your time trying to figure out theory questions. Just go into your study guide, you'll find the answer there. Right. So you just look for users of financial information. Let's see. Users of financial information. Users of financial information. So it should be unit number 2. Okay, let's see. Unit number 2. There you go. Users. So it's 2.2, users of financial information. Using examples, discuss the main users of financial information. So you just take this information there, right? You've got a list of users. You've got internal users, 3 of them, and you've got external users, 6 of them. So in the exam situation, just take these answers. Just take these answers there and then put them in your own words. So you just highlight that you've got shareholders, and then you explain what are shareholders in your own words. You highlight there is management and explain what are management and what do they use financial statements for in your own words. You highlight that they are workers, customers, suppliers, lenders, competitors, investors, government, and what you just need. Don't just copy and paste as it is, but take the subheadings, right? Take the names and then just write it in your own words. Just write it in your own words. The same information that is there, just write it in your what? In your own words. So that's what? That's 1.3. So this one is just in the study guide, right? Just check your study guide for 1.3, right? You don't need to reference, you don't need to worry about that, right? So question 2. So let's see, question 2, what does it say? Now, the extract of the financial statements of Zambezi Limited for 2020 and 2019, and we've got them here. All right, we're supposed to do ratios. Oh, this one was straightforward. So what are we doing? Calculate the following, and we're applicable round to 2 decimal places. Right, so we're supposed to calculate the ratios for 2020. It doesn't say explain the ratios, it just says calculate. So these were like 3 marks. If you had said calculate and comment on the ratios, then we would say, yeah, it was going to be difficult. But it's just saying calculate the ratios, right? Calculate the following ratios, and we're applicable around 2 decimal places. So it's just 5 marks for calculation. So again, with ratios, like I said, these are in your study guide. You don't need to really worry much about it. So 2.1, it says here, calculate the gross profit, right?
Next
So you go in your study guide under the ratio analysis. That was unit number 8, if I'm not mistaken. What is it? Unit number ratio analysis 6, right? You go and check this gross profit is profitability ratios, right? So gross profit margin, there it is, gross profit divided by sales. So you just indicate the ratio. What is it? Gross profit divided by what? By sales multiplied by 100, right?
James,
Yes.
That's margin.
is that not gross profit? Because you have a look at the table. It doesn't give you the amount for gross profit. Your next question, 2.2, will be gross profit margin.
Oh, sorry. Sorry,
Yes, yes.
I jumped. Sorry.
So they just want gross profit
Okay.
only there.
Sorry, I jumped. This is what 2.2 gross profit margin. All right. Gross profit margin. So 1 to 2.1. 2.1 gross profit. All right. So let's go. 2.1 gross profit. Okay. So you've got your sales, your cost of sales. Again, straightforward stuff, right? You know your income statement. If you go to those notes that I've given you, how do you calculate gross profit? So you're going to say gross profit is equals to sales minus the cost of sales, right? So gross profit is equals to our sales, which is 1920,123 minus the cost of sales, which is 1,200,123, and then that gives you an answer there. I'm not sure what the answer will be. Let's put in a calculator. 1920 minus 1,200. You can correct me if I'm wrong, but I get 720. Is that
That's
correct?
correct.
All right.
Yes.
So that's our what? That's our gross profit, right? So we move on to the next question was what? 2.2. Yeah, that's what the one that I was doing. It now needs the gross profit margin. So gross profit, you have it now, 720, 123, divided by the sales figure, which is what? 1920. 1920, 123, and you multiply everything by what? By 100. Multiply by 100, and you put in a calculator. So 720 divided by 1920, multiplied by 100, gives me 37%. If I'm wrong, please correct me. 37.5%. That's the answer that I finally end up with. So again, you can see it's very ratios, like I told
James?
you. Yes?
Sorry, they say we must round it off to 2 decimal places.
So it's going to be FS0 at the end. 37.50. All right. So, like I said, ratios are pretty straightforward at the end because you're just applying formulas. There is really not much work that you can do on ratio analysis other than just apply the formulas that were provided with, right? So you go to the next ratio, which is 2.3. 2.3 wants you to do the data's collection. Data's collection schedule. Right? So like you highlighted last week that your lecturer loves to do averages. So we're going to use the averages formula since we have both the information for 2020 and the information for 2019, right? So data's collection is going to be average datas divided by credit sales multiplied by 100, right? So again, the formula should be there in your study guide under data is activity ratios. If you go under activity ratios, average collection period. So this is the formula that we're trying to use, average collection period. But like I was trying to tell you last week, most lecturers, they don't use averages. Most lecturers, they use just the recent accounts receivable. But since your lecturer was using averages in his lectures, then we will have to use averages for him so that we score the full marks. But most lecturers don't use averages. They just use the final figure. All right.
And should it not be times 360?
Oh, yeah, times 360. 360 times 360, right? So, let's see. I don't like using this formula at all. But anyway, where is it? Average, what datas? Where are our datas? Receivables. There we are, right? So if we're using the averages formula, the first thing that we need to do is calculate the average datas, right? Or the average receivables, right? So that's going to be 504, 123 plus 300, 123 divided by 2, and that gives us the average, which is going to be 544, 123 plus 300 divided by 2. That gives us 402, 123. So that's our average there. And then we use that average. So it's going to be 402, 123 divided by the credit sales. Are we told anything about issues of credit sales here? Or all sales are on credit, that's fine, right? So divided by 920, 123 multiplied by, is it 360 or 365? 360 multiplied by 360, 360. And then we get our answer there. 402, 123 plus 1920, 123. That gives us here multiplied by, oh, sorry, minus.
It's divided by.
Divided by, right? And then that gives us 360 there, and then 75. 75.38 days. 75.38 days. But like I said, the trick for this question in particular is if you follow the what you call it, this in the study guide, you will get a different answer. you will get a different answer if you follow exactly what is in the study guide. What I'm following here is like, I think one of you highlighted last week that when you were doing the class with your lecturer, instead of using the account receivable, you used the averages, right? So that's what I have done here. I've used the averages like what? Like it did. So if you follow the one in the study guide directly, you will get a slightly different answer because the one in the study guide does not have averages. You are just using the final figure, which is 504 divided by what? By the credit sales. So that's where it's slightly different, right?
James, so okay, in this case, even though it says to calculate the following for 2020, you still average it. You don't just use the 2020 figures.
No, not exactly. So what happens with this formula for data's, right? For data's collection period and for creditors collection period is there are actually two formulas in the academic world. There are actually two formulas that are used by lecturers. It's either you use the standard formula, which does not have averages, which is just your accounts receivable divided by your credit sales multiplied by 360. Which is the standard formula that almost every other person uses. But however, there are some lecturers who use an averages formula, where you use average. When I say average, is you're taking the previous sales and the previous data and the current data, and you're getting an average, right? And then you divide that average by the credit sales. It is still correct. Technically, it is still correct. There's nothing wrong with it. It's just that it's something that people rarely use in the accounting world anymore, because most of the time when you're asked to calculate ratios, you might not be provided the information for both years. But if you are provided information for both years, for your lecturer, please use the average, because that's what he was using when he was teaching you guys, which means that is what his preference is. But if he does not give you all of the information, so for example, if he had only given you 2020 information, then you don't need to use the average, right? Then you don't need to use them.
Okay, thanks. Yeah, I was just about, uncertain about whether, if they give you just for 1 year, if you average it out or not. Thank you.
That's fine. Then also what you can do, if you really want to get a final answer, a final conclusion on this, you can even email the lecturer so that he confirms that for ratio analysis, when we are doing accounts receivables and when we are doing accounts payables days, should we use average data or should we use just the current data for the year? You can even just send him an email and then you can see how he responds to that, and then you can use that as the final conclusion to that issue. Because what he was teaching you guys in the lecture is different from what is in his study guide. Me, I was teaching based on his study guide, but after being informed that he's using averages in the lecture, that is why I've changed my formula also to averages. All right, so that's 2.3. Now we go to 2.4. Now 2.4, what did it want? Current ratio. Current ratio. So current ratio is your current assets divided by your current liabilities. So you check what are your current assets. In this particular case, you are not given the exact figure of current assets and current liabilities, which means you need to add. So your current assets are going to be your inventories plus your accounts receivables plus your cash and cash equivalents. All of that you divided by your current liabilities, right? So this means that your current assets, remember it's for 2020, it's going to be 532,123 plus 300, 123, plus 440,123, all of that divided by 408, 123. And then you put that in a calculator and you get your final answer for the what? For the current ratio, right? So we go to the next one, which is going to be the quick ratio, right? Quick ratio. So again, the quick ratio is very straightforward. Quick ratio, the normal formula is current assets, right? Minus the inventories, right? Divided by the current liabilities. So you can take the figure that you got for current assets there and then subtract the inventories. Or in simple terms, you can just add, right? Your accounts receivables, which is 300, plus your cash and cash equivalents, which is 440, and you divide all of that by 408. Right? And then you get your what? Your quick ratio, right? All right. So you go to the next one, which is 2.6, 2.6, which is given the industry average of gross margin of
James?
Yes.
Sorry, I'm a bit lost. Okay, so you didn't give us the answer for 2.4.
Yes, no, I did not. You can calculate it from your side.
Oh, okay.
All right, sure.
Sorry, James, just sorry, man. The inventories would be the same as you said cash and cash equivalents, right?
The inventories, yes, the figure for the inventories. Inventories 532.
Yeah.
Yes.
Okay, but in the quick ratio calculation, why did you use 440?
440. Okay. All right. So let's do it this way, right? We said current assets minus current inventories. What are your current assets, if I may ask you, of these three things, of the things listed here? Which are current assets?
It would be
Accounts receivable.
account receivable.
Yes.
Cash. And inventory.
And inventories, right? So if I say current assets less inventories, which figures are we including?
So it's all those figures we just mentioned minus the 532.
Yes. So that's why you don't see 532 here. I've subtracted it already.
Okay. Oh, okay.
Sure. Okay. 2.6. Given the industry average, gross profit margin of 42%, comment on Zambezi Limited's gross profit margin. So we did the gross profit margin for Zambezi and we got 37%, right? And then we are told here that the industry average is 42%. So gross profit margin, the higher it is, the better it is for your company, right? So you can see that the industry average is higher than the company's average. So our comment is therefore that the company is not performing very well, because it is below the industry average, which means that other companies in the industry have got a better gross profit margin than our specific company. So that's our final conclusion for 2.6, that the company has got a bad performance. It is performing below the what? The average performance that other companies in the industry are performing. So that's our conclusion to 2.6. So that's ratio analysis, right? So again, like I said, ratio analysis is very straightforward. You are just applying the formulas within your what? Within your study guide. So you should not have any challenges on this one. All right, we go to the next one, question number 3. Question 3, we are given here project A and project B. We are given, oh, wonderful. We're given cash flows and we're given net profit. And we are told to calculate payback, accounting rate of return, and etc. All right, so let's do that. Let's see. All right. So payback period for both projects expressed in years, months, and days. So payback period for both projects. So remember, when we are doing the payback period, we use cash flows. That's for the payback period. When we're doing accounting rate of return, we use what do you call this? Sorry. We use net profit. And then profitability index, we use cash flows. And then final one, it's a conclusion based on the calculations. Okay, final one is a conclusion. Right, so let's start with the payback period. So, okay, Thinking, should I show you? All right, let me not show you shortcuts. You get stuck in the exam if I show you too many shortcuts. All right, let's go through the normal way. All right, so I've got our narration, got our value here. All right, so let's call this project A. All right, investment. How much did we invest? 220, 220, 123. And then year one inflow, and then balance outstanding. All right. So year one, how much money did we get? Under our cash flows, we got 80,000. So 80,000, and then we put that in a calculator. Negative 220, 123. 80,000. We are left here with 140. And then we go to year number 2. 80,000 that we receive in year number 2, and then we end up with 60,000. And then we go to year number 3. So year number 3, when we receive 80,000 in year number 3, then we can know that we are now fully paid off, right? So we are starting from year number 0, right? Where we said that we made an investment of 220,000. And then in the first year, we got back 80,000, which means that the balance was 140,000. And then in the second year, we got another 80,000, and the balance was 60,000. And then in year number 3, we got another 80,000, and therefore we no longer had the balance. We have now fully repaid all of the money back, right? So then we want to calculate how many years did it take us to pay back. So it's gonna be this is year 1, year 2, and then we pay back in year number 3. So it's gonna be 2 years, 2 years plus how much money was left? 60,000. 60,000 divided by 80,000, right? And then we multiply that by the what? By the period, which is 12 months. So 2 years plus 60,000 divided by 80,000 multiplied by 12 months, that's 9 months. Right. So 2 years, 9 months is our final solution for project A. Right. We go to project B.
And if they tell you that your answer must be years, months, and days.
Yes, it should be years, months, and days, but there are no days on this one.
So you don't say 0 days.
No. If it's 0, it's 0. You don't need to write 0 days.
Okay.
All right, sure. All right, so we go to project B, right? So project B, same amount invested, but we have got different cash flows coming through, right? So in year number 1, we received 70,000. 70,000. In year number 2, we received 100,000. In year number 3, we received 90,000. Okay, let's do the calculations. 220. 220, 123, plus 70,000 cash flow, we get 150 here. 150 is the balance as at year number 1, and then we get into year number 2, we add another 100,000, and then year number 2, our balance is 50,000. And then we go to year number 3, we can notice that we have now fully paid because we get 90,000 when our balance is 50,000. So again, it's gonna be 2 years. 2 years plus how many months do we have here? We've got 50,000, which was left, divided by 90,000 multiplied by 12, right? So 2 years plus 50,000, 50 divided by 90 multiplied by 12 gives me 6,6667 months, right? That's my what? That's my months there, but I need to convert those months to days. So plus 6 months plus how many days? 0,6667 whatever, multiplied by 30 days. Multiplied by 30 days. So 2 years plus 6 months plus how many days? Put that in a calculator. 0.6667 multiplied by 30. That gives you 20 days. 20 days. So that's my final solution for project number B, right? So I got my 6 marks for 3.1 there, right? We got to 3.2. Yeah, that's fine. 3.2. So 3.2 is accounting rate of return, and we use the average profit, right? Then net profit, right? So ARR is going to be equals to average annual profit divided by.
Sorry, James.
Yes.
James.
Yes.
Can you just go a little bit up? I need to. Yeah, just stop there. Yeah, thanks. You can continue.
All right, it's fine. Let me just save this. Answers.
So that one, so we don't round it off to like say 2 decimals. Do we keep it like that?
No, we keep it like this.
That's 6667.
Okay, no, it's not the final answer. The final answer is this one. You can round it if you want.
But I mean that one, well, yeah, because I now rounded it off to that. Then I get 20.1 days. So then I said it will be 20 days. I mean 21 days, sorry.
Yeah, it's neither here nor there. It's neither here nor there.
So that doesn't really make a difference.
Yeah, to be honest with you, not really.
Okay.
Yeah.
Can I say that it's better to just if you're using a calculator, just don't go with it step by step and don't round off your answer. Then you should get to the 20 days. I'm sorry, I just thought I'd add that.
Because when you're rounding off, most of the time when we're talking about rounding off, we are talking about your final answer. The final answer that you present is the answer that we talk about when you're rounding off. In the middle, when you're still doing your calculations, if you start rounding off early in your calculations, you might end up with very funny answers at the end of the day. But either way, it's neither here nor there. Your final answer will still be around 20 days. All right. Let's see, where was I? What was I doing?
You're looking for net profit.
Okay, net profit. All right. Average annual profit of, okay, yeah, I wanted to check something here. Accounting rate of return on project B. So accounting rate of return, it's like what we're talking about under the ratios. It has 2 formulas also. It has a formula where we use average investment and the formula where we use initial investment. There's 2 formulas. So let's just check which formula your lecturer prefers. Accounting rate of return. Right. Accounting rate. Because it has 2 formulas also in the academic world. So you need to know which formula does your lecturer prefer, and then you use that one. So you can see here, it says here, accounting rate of return, right? Accounting rate of return, also known as the average rate of return. It's average earnings after tax divided by average investment. Now, let me give you a caveat then. When you get your question paper, when you're answering this question, check the wording that he uses here. Please check the wording that he uses here, right? So your lecturer might write accounting rate of return on initial investment. If he says on initial investment, do not use the formula which says divided by average investment. It means you have to divide by the initial investment. But if he is silent, just like this question, where it just says accounting rate of return, then you use the average investment. Or if he says accounting rate of return on average investment, then you use the average investment. But if he actually specifies that its own initial investment, you divide by the initial investment, because there are actually two formulas for doing the accounting rate of return. So for this one, we are going to use the average because it is silent on the issue. So we're going to use the normal formula, which is average investment. Right. So ARR, project B is the one that we want.
Sorry, James.
Yes.
Okay, I just want to find out, why do we have to use the average here when it's specifically talking about project B only?
Why do we have to what?
I say, why do we have to use the average? Because it's only talking about project B.
Okay, there's somewhere where you are not understanding, but I'll explain it, don't worry. When we talk about average, you see what I'm talking about. It's not what you're thinking, but you see what I'm talking about.
Okay.
All right, sure. Right. So for us to calculate accounting rate of return, we're going to first need what is the average annual profit, right? Average annual profit. And then we need to know what is the average investment, because that's what the formula is saying. We need to know what is the average investment, right? So average annual profit is going to be the total profit for project B, right? Divided by the number of years, right? Divided by the number of years, right? And then the average investment is going to be the initial investment for project B plus the scrip value for project B divided by 2. That's the average investment for what? For project B, right? So let's do the first one, which is our what? Our total profit, right? So our total profit, we're just going to add up all of the figures there. 15,000. Please don't make the mistake of adding cash flows. 15,000 plus 45 plus 35,000 plus 5,000, and then we get 100,000, right? So 100,000 divided by number of years, which is 4, and then we get our average profit of 25,000 per year, right? And then average investment is going to be our initial investment, which is what, 220, 220, 123, plus our scrip value, which is 0, divided by 2, which gives us 110, 123, right? Are we together here?
Yes, we're still with you, James.
Sure. Yes. So our ARR is therefore the total, the average annual profit, which is 25,000, divided by the what? The average investment, which is 110, multiplied by what? By 100. Make it a percentage, right? So 25 divided by 110 multiplied by 100, and that gives you 22.72 73, 22.73%. That's our final answer there. I hope my friend, you got it, the one that was asking about the average issues.
Yes, I got it.
Sure. All right. So that's 3.2. Right. We go to the next question, which is 3.3, profitability index. Okay. So again, you can double check this in your study guide. The formulas are already there. You have got your formulas for payback, formulas for how you're supposed to do the calculations at the end of the day. So profitability index, where is our profitability index? Evaluating, it's under NPV. Discounted payback, net present value, profitability index. There you go. So profitability index is equals to the present value of all the future cash flows divided by the what? By the investment. So that's profitability index, right? Profitability index is equals to the present value of cash flows divided by the initial investment. So this means that we first need to calculate what is the present value of the cash flows. So for us to be able to do that, we're going to create a table. Which project are we doing? Is it all of them or is just one? profitability index for both projects. All right, it's for both projects. All right, so we're going to start with project A, and then we're going to do project B. All right. So we're going to create a table here. All right. Yes, cash flow, discount factor, present value. All right. So project A. Okay, so project A is something that is unique. Project A has got similar cash flows all year, all throughout. Remember what we talked about last lecture? We said that if you have got the same cash flow, then that cash flow is an annuity. And when you have an annuity, you can use the second table, right, for a regular annuity. So it's going to be 4 years. So 1 up to 4, right? And then our cash flow is going to be 80,000 per year. 80,000 per year. And then our discount factor, do we have a table here? No, we don't. All right, let's go to our study guide for the table. So we want the table number 2. Table number 2, the one for regular annuity, right? Present value of a regular annuity, because 80,000 is a regular annuity. We are receiving 80,000 per year for 4 years, right? So what is our cost of capital is 15% for 4 years. So on our second table, 15% for 4 years gives us here 2.8550, right? So our present value is going to be 80,000 divided by, multiplied by 2.8550. So that's going to give me here 28,400. All right, so that's my present value. But remember, I also have an investment of 220. 220, is that correct? Yes, 220, 123. And then I know my profitability index. We say the formula is present value of cash flow divided by initial investment. So if I then say 228,400 divided by 220,123, then I get my final answer of 1.04 as my what? As my profitability index. Are we together here? Are we together?
Yes.
Yes.
Yes, we're still with you, James.
All right. So we go to project number B. Project number B is going to be slightly different because project number B, it does not have the, it does not have similar cash flows. The cash flows are different for each and every year. So it means that we need to go the long route, right, for project number B, right? So we're going to have our year, we're going to have our cash flow, we're going to have our discount factor, we're going to have our present value, right? So how many years do we have? 4 years, and then we're going to have our total present value, and then our investment, and then our profitability index, PI, right? So cash flows, project B, we've got 70,000, we've got 100,000, we've got 90,000, we've got 60,000. So make sure that you use the correct figures. Don't go and then take profits. Profitability index to use cash flows. Our discount factors. So this one we are going to use table number 1 since it's not an annuity, right? So again, our cost of capital is 15%, right? So 15% for year number 1, we're going to have 0.8696, right? 15% year number 2, we're going to have 0.7561. You can correct me if I've made any mistakes. Year number 3, 0.6575. And then year number 4, 0.5718. Hope this is correct. All right, it's fine. So we put it in a calculator. 70,000 multiplied by 0.8696. We get here 60, 872. And 100,000 multiplied by that, we get 75, 610. 90,000 multiplied by 0.6575, we get 59, 175, and then 60,000 multiplied by 0.5718, we get 34, 308, right? So 60, 872 plus 75, 610 plus 59, 175 plus 34, 308 gives me my final figure of 229,965, right? So that's my total present value there, right? You divide that by the initial investment of 220, right? 220, 123, and then you get your final answer of 1.05. That's my profitability index there, 1.05, right? So we're done with a profitability index. I don't know if anyone got lost there. Then we go to 3.4. Oh, sorry. All of this was 3.3. Where did I put it? Okay. Like that. Okay, so 3.4. Based on your calculations in 3.1 and 3.3, which of the two projects would you recommend and explain why? Right. So,
sorry, another thing is it just says there your answer is 3.4, 3.3, sorry. Answers to be expressed to 3 decimal places.
Oh, you said 3. Okay, sorry.
Yes.
I missed that. So this one was going to be 4, 5. Yeah, so you can see some of those small mistakes. Please take care of them in the exam. Just pay attention a little bit. Don't be like James. Divided by 220. So this one was 3.8. 3.8. All right, that's fine. So based on your calculations on 3.1 and 3.2, 3.3, which projects would you choose? So what I would recommend for a solution for this one is you can then say recommendation based on 3.1, right? And then you conclude based on 3.1 first, right? So 3.1, which is payback. The shorter the payback, the better the project. So which of the two projects had a shorter payback period, right? Project B was 2 years, 6 months, 20 days. Project A was 2 years, 9 months. Therefore, project B was the better project, right? So you can write here, project B had a shorter payback period, right? So you want to choose project B, right? But you also say recommendation based on what? Based on 3.3, right? So 3.3, you want the one with the higher profitability index, and that's project what? Project B, which has got a profitability index of 1.045, right? So project B had a better or higher profitability index, right? So your final conclusion is choose project B, right? But there are situations whereby there may be conflict, right? You might notice that your choice under the payback might be different than your choice under profitability index or your choice under NPV. Then you have to know which method is a better method for making a choice. So net present value, internal rate of return, and the profitability index. These are better methods than payback and accounting rate of return. So whenever there is a conflict, you can choose based on NPV profitability index, and IRR, right? You can choose based on those ones, right? Now, if you have got a choice between profitability index, an NPV, and IRR, they will give you the same choice because they are the same method. The method that you use to calculate NPV and the method that you use to calculate profitability index and the method that you use to calculate IRR are the same. So they will give you the same choice. They will never have any conflict. But it might have conflict with the payback. It might have conflict with the accounting rate of return because those are completely different methods. But always choose these ones where you calculate the time value of money concept, because that is an important concept in finance. That is an important concept in finance. All right. So question number 4. Okay. So that will be our last question for today. Question number 4. Okay. Create a comprehensive income statement. All right. So let's see. Right. So we're given here a trial balance and some additional information, and we're told to create a comprehensive income statement. Right. So remember, your income statement, you're going to have your sales, right? Less your cost of sales, right? And then that gives you a gross profit. Gross profit. And then you've got your additional income. Right, and there will be different types of additional income. And then you've got your gross income. And then you've got your expenses. And there are going to be different types of expenses that you face. And then you're going to have your operating income. Etc. As we go down, let's just go through it. All right. So let's start with the issue of the sales. So when you're preparing your comprehensive income statement, you look at the nominal account section. That's where you mainly focus on, right? So we're going to have your sales figure here, which is 1,234,123, minus your sales returns, which is 18,120. Right? 1,234,123 minus 18,120, then that gives you 1,215,880, right? And then cost of sales, you're given here your cost of sales figure of 725,880, 725,880, and then you're gonna have your gross profit of 490. Right? And then you now go through your additional information and your expenses and whatnot. But these figures here under your nominal account section, specifically as you go down them, these are unadjusted figures because you've got additional information, which means you need to adjust them for the additional information. So that's what we are going to go through. So I might not quickly put in the totals because I want us to do the adjustments first. Right? So let's start with additional info, with our additional income. All right. So what additional income do we have? We've got fee income. Remember, when you're looking for additional income, just look in the credit side. Expenses are debit accounts. Incomes are credit accounts. So just look on the credit side, right? So you've got a fee income, you've got a discount received, right? And then you've got interest on a fixed deposit. But interest on a fixed deposit is recorded after your operating income, after your operating profit. Because remember, you say operating profit, and then you add interest income, you subtract interest expense. So this one for now, we are not interested in it. We'll deal with it later, right? So that's your fee income. It was 610,925 and then discount received was 490. Right. So we just leave them like that for now and see if there are any additional things that we need to adjust. Right. Let's go to our expenses. So what type of expenses do we have for this organization? Let's increase it a little bit so that I can see. My eyes are not as good as they used to be. So under our expenses, we've got salaries, which is 400. I'm just putting them under workings for now, so that when we adjust, we can put the final figure. We've got bad debts, which is 42. And then we've got bank charges, which is 35. And then we've got insurance, which is 23. We've got electricity, which is 27. We have telephone, which is 10.8. I think maybe let me just reduce it a little bit so that it's on the same page. Okay. Telephone, and then the rent expense, which is 143. And then with interest on loan, or at interest on loan, let's keep it for now. I'll come back to it, don't worry. And then we have got security, which is 23,800. And then we've got consumables, which is 18,000. And then we've got adverts, which is 20,550. And then we have vehicles expense, which is 13,275. There were so many expenses. And then we have got a staff development.
It's 13,275.
13, all right. 13,275, and then staff development, which is 25,000. Right. And then okay. I think I jumped a couple of things there. Right. So we're gonna end up with our operating profit here. And then after operating profit, we've got to add interest income, and then less interest expense. And then we're gonna have our net profit. Right. So our interest income here, it's 7,875. And our interest expense is 3,7,800. All right, so now let's go through our adjustments, right? So we've listed everything there. We can now go through our adjustments and see how we can adjust each and every one of these figures. All right, so adjustments. Adjustment number A, fee income of 4,600 has been received in advance, which means that on our fee income here of 610,000, right, 4,600 is paid for in advance. We don't need it this year, because remember, we only want to record the fee income for the current year. So we're gonna subtract minus 4,600 there for us to get our final figure for fee income, right? So 610,925 minus 4,600, and then we get our final figure of 606,325. That's for what? For fee income. That's for our fee income there, right? Next one. No entry has been made for a direct deposit of 2,000 made by a debtor whose account has been written off as irrecoverable. All right. So there was a debtor who we had written off as irrecoverable. which means we had already written that this is a bad debtor, right? But this bad debtor has paid us some money now. So we have recovered a bad debt. So a bad debt recovered is considered as an income. So we can say here, a bad debt recovered, right? Bad debt recovered of how much? How much was it? 2,000, right? So we've got a bad debt recovered of 2,000 here. And then we've got a discount here of 4.9. All right. So that's our additional income there. We continue. Consumables. In consumables include an amount of 120 for photocopies made for receipt books, right? By the proprietor. So according to the accounting entity concept, if the owner of the business uses anything in the business for personal gain, it's not part of business expenses, right? So we need to remove this 120. So on our consumables here, we are saying minus 120 because 120 was not spent by the business, but it was spent by the owner of the business for personal things. So we need to subtract the 120 there. We go to D, physical stock taking. On 28 February, revealed the following inventories on hand: 153 and 880. And 153 was trading inventory and 880 was consumables. So consumables, again, we are saying that there is money that was not used by the organization. So there is stock that was not used by the organization in terms of consumables. So we cannot include it because it's for next year. So we're going to remove 880, right? So our final figure for consumables is going to be 18,000 minus 120 minus 880. And then we're going to end up with, interesting, 17,000. All right. So 17,000 for consumables, right? But we are also told about trading inventory. So what is the impact of trading inventory? We go and compare with the trading, with the balance sheet. So in the balance sheet, oh yeah, interesting. So this was one of those questions that really, really vexed me. I remember this exam. Very, very well. I had forgotten about it. All right. So trading inventory, it says here we've got 146,000 in the trade in the balance sheet, right? And then we counted the trading inventory and we see we've got 153. That's very, very unique. You rarely see questions like this. Most of the time in the exam, the trading inventory in the balance sheet will be more than the physical stock take that you count. So what usually happens in a company is you go and count your stock. So according to the books, you will say, oh, we've got 200,000 in stock. But after counting it, you see you only have 190,000. So it means that either 10,000 was damaged and was disposed of, or 10,000 was stolen, and you record it as an expense. And the expense there is trading stock deficit expense. But in this particular situation, you actually have got more stock. It's like you recorded in your books less than what you have in your in your actual physical stock. So personally, I've never made a question like this one. This is why I'm saying that this question really vexed me in this particular exam, because this was completely new to me. So I'm going to advise you what I did, but I'm honestly not 100% sure if that's what your lecturer wants. I would recommend, if possible, one of you guys can maybe send him a message and just ask him, how were we supposed to deal with this paper? You can just send him the paper and ask him, how were we supposed to deal with this trading inventory? Because honestly speaking, this is the first time that I've seen this in accounting, where you count stock and the stock is more than the stock in the in the books. All right. So where we usually record trading inventory deficit, what I did in this particular exam is I recorded trading inventory gained. That's what I did. That's what I did. Inventory gained. And I recorded the difference, which is what? 153. 153,000 minus 146. Because it looks like we gained trading inventory. According to our books, we should have 146, but when we count the inventory, we have more. We have 153. So it looks like we've gained trading inventory. But like I said, on this one, I honestly am not 100% sure if I did the correct thing for this exam, because I did not see what the final mark was, but they are for this exam, right? So, but that's how I handled it. That's how I handled it personally. I just included it as trading inventory gained, right? So, that should, yeah. So that concludes our additional information. I don't think we have any additional information anymore other than these ones. So we can add up all of our additional information, additional income, 606, 325, plus 4900, plus 2000, plus 7000, and then we end up here with 620225. Right. So that's our additional income, which means now we can calculate our gross income, which is going to be this figure there plus this figure there before we go to adjustments for expenses, right? So plus 490, 123, and then we end up with 110,225. Right, so now let's go through all of the rest of the adjustments, right? So adjustment number E, there is a payment for 2200 on 27 February 2020 for security services that had been incorrectly recorded as insurance. All right, so what we are going to do is we are going to go to security services, and we're going to add 2200, and then we are going to go to insurance, and we're going to subtract 2200. I hope you understood why we did that, because we're saying that it was recorded under insurance incorrectly, but it's not insurance. So we need to remove it from insurance. And then after removing it from insurance, we need to add it to the correct account, which is security services. Right. We'll go to the next one. Adjustment number F. The landlord has increased the monthly rent by 2,000 as per tenancy agreement with effect from 1 September. Rent for February 2020 has not yet been paid. All right, that's interesting. All right, so we are saying that the rent that we have is from 1 March 2021 up to 31 January 2020, because for February it has not yet been paid, right? That's what it's saying, right? So how many months is that, right? So that's 11 months. You can correct me if I'm wrong. Let's do some workings here, right? Rent, right? So how many months paid? That's what, that's 11 months. Was February has not yet been paid, right? And how much have been paid for the 11 months? It's rent expense, it's 143, right? It's 143, right? But we are also told that the rent increased by 2,000 a month. And when did it increase by 2,000 a month? In September. So September, October, November, December, January, 5 months. So for 5 months, we paid extra 2,000 a month, right? So how much extra rent did we pay? That's what? That's 10,000, right? That's the extra rent that we paid. So before the increase, it was 143, 100 minus this 10,000 gives you 133, 100. And this 133, 100, you can divide it by what? By 11 months. Did I miss anything there? Monthly 2,000. Okay, no, everything still seems so correct. 133, 100 divided by 11 gives me 112, 100 as the monthly rental before the increase. So what is the rent for February? It's gonna be 12,100 plus, how much was the increase? 2,000, which is 14,100. So we go to rent expense, rent expense, and we add 14,100 for my rent fare. Go to the next one. Advertising. In advertising contract costing, 1320 was paid and recorded on 1 August 2020. This contract expires 31 July 2020. Make the necessary adjustments. So this for a whole year, right? 1 August 2019 to 31 July 2020. That's for a whole year. Right. So what are we going to say? We are going to say 1320 divided by 12, which means that each and every month they were paying 110 Rand for this contract. Because remember, it's 1320 for the whole year. So the monthly advertising expense was 110, right? So we want to make the adjustments. Remember, our statement is ending at 28 February 2020, right? But this contract is ending 31 July 2020. So we want to remove the advertising expense for March 2020, for April 2020, for May 2020, for July 2020, and for June 2020. So that's 5 months, right? That's March, April, May, June, July that we want to remove, right? So it's gonna be 5 months multiplied by the monthly expense, which was 110 Rand, right? So we go to, this is what? Advertising, right? So 110 multiplied by 5. So minus 110 multiplied by 5. Right. We go to the next one. All right. We can do the calculations actually. All right, it's fine. Let's just add everything up. I think we're almost done there. So that we don't leave anything out. All right. I'm just checking if there's anything else that is critical. No. All right. So salaries didn't change. They're the same. Bed debts didn't change. They're the same. 3,500 bank charges, insurance, 2,300 minus 2,200. That's 21,200. 27,400. 10,800. This one 143 plus 1,400. 157,200. Then 2,300. 20 minus 220. 21,600. And then
That can't be correct.
Sorry?
That
You must
can't
add
be
it.
right.
Oh, it's
Because
added.
it's 800.
23,800 plus 220. Oh, sorry, it's 26. 26,000. And then this one 20550 minus 110 multiplied by 5 gives you 20,000. And then this one 13,275. This one 25,000. And then we want to add a few expenses there. We've got depreciation. Depreciation, we've got depreciation, and then we've got provision. Bad debts. All right, let's go through. All right, so annual depreciation is provided for as follows: 12% on cost for equipment. So we go, what is the equipment? 270,000, and we want 12%. So 12% multiplied by 270. So this one is straightforward. 270 multiplied by 12%. That gives us 32,400. And then on vehicles, 20% on the diminishing balance method. So 20% multiplied by the diminishing balance of vehicles. What is the diminishing balance of vehicles? We have 750, 123, minus the accumulated, which is 366. right? So 750, 123, minus 366,000 to get the diminishing balance multiplied by 20%, and then we get 76. 800, and then our last entry, or not our last, second from last, says here, a provision for bad debts must be increased by 1.5. So there's an increase in provision for bad debts. So remember, increase in provision for bad debts, it's an expense. So we're going to expense here 1,500. It says increased by, it does not say to. Remember language, English, increased by, which means they've already calculated for us how much it increased by. Right, so we just put the 1.5 there. Right, then it says here, provide.
Sorry, James.
Yes.
If on the nominal section of the income statement, if we had a provision for bad debts, let's say 5,000 rand, so it was going to be 5,000 plus 1.5.
On the nominal account section of the balance sheet, you will not have a provision for bad debts. You will not see a question paper that is a provision for bad debts. On the nominal account section, you have bad debts. This figure here for bad debts, the 4.2. Where you have the provision for bad debts, it's under the balance sheet. If you go under the balance sheet section where it says provision for bad debts, 3.5.
Oh, sorry. Yes,
it says 3.5
okay.
there, right? But the English, that's what I'm saying English, it says it has increased by, which means they've already calculated the change. Because what you want for provision for bad debts is the change. If he had said that it had increased to 5,000, then you would say 5,000 minus the 3.5 to get the change, which is 1.5, which is what we recorded there. Yeah, but it already tells that it increased by what? By 1.5. Right. This actually means that this account, when you go to the statement of financial position, the balance sheet, this account is now 5,000. Because it is now the 3.5 that was already there, plus the change, which is 1.5, giving you 5,000. If you're doing the balance sheet, but you're doing the income statement. In the income statement, you only want the change, the rate of increase that has happened, which is 1.5. All right. So we go to the next one, which is provide for interest on fixed deposit. And so these ones are after our operating income. So we can actually calculate our operating income. So let's add all of our expenses together. So 400,000 plus 4,200 plus 3,500 plus 21,200 plus 27,400 plus 10,800 plus 157,200 plus 26,000 plus 17,000 plus 20,000 plus 13,275 plus 25,000 plus 32,400 plus 76,800 plus 1,500, and that gives us a total expenses figure of 8,362.75 is our expenses figure there, right? So okay, let's just highlight all of these so that they don't distract us from what we are doing. All right. So that figure we subtracted from our gross income 1,110,225, and then it gives us here a final operating profit of 273,950, right? And then we can now talk about interest. So provide for outstanding interest on fixed deposit. Interest on loan for the last quarter is outstanding. All right. So the best way to do these ones is to just check the, what you call it, the percentages, right? So fixed deposit says 13% per annum, right? So the easiest way to do this is just to say 13.5% multiplied by the fixed deposit, which is 70,000, right? And then the loan interest says 18% per annum. The best way to do this is just say 18% and multiply by 280. So that you just get the full year at once. So 13.5%, 0.135, multiplied by 70,000. And then you have 9,450. And then 18% multiplied by 280. And then you've got 50,400. I just calculated the annual and put the annual there. You can calculate the outstanding and add it to the whatnot, but you arrive at the same answer at the end of the day, right? So 273,950 plus 945 minus 5,400, and then you get 233,000 as your final net profit for the what? For the organization. So that's how you were supposed to do question number 4. That's how you were supposed to do question number 4. So, ladies and gentlemen, we are done with this paper. I'll send you the video and the notes that we were writing. Let me just indicate what paper is this. 26 November 2021. 26 November 2021. So our next meeting will be during the week next week. Yeah, no, there's no text. There's definitely no text. There's definitely no text. So our next meeting will be next week during the week. When are you guys writing your advanced management?
Before that, just a quick one. Do we have a class today late?
I don't think so.
7 p.m. I
Which
saw
module is
something
it?
7 p.m. For business finance. Is it? Because I saw something like 7 p.m.
No, I think it's AMP. I think it's the last lecture for advanced management principles.
It's management principles.
Yes, it's management.
Oh, 7 p.m. is management principle.
Yes, it's management
Thank you.
principles.
Thank you so much.
It's the last lecture
Okay.
for management principles. So I know that you guys are
Okay.
writing next week. Which day are you writing next week?
Wednesday.
On Wednesday.
Wednesday. Yeah.
We are Wednesday.
So meeting on Tuesday might not be a good thing. Meeting on Tuesday might not. So we might have to meet on Thursday. We might have to meet on Thursday for business finance. But I'll see. I will advise the final date for our next class. But the next class that we meet for business finance will be our last class. The next class that we meet for business finance will be our last class. But our advice, because I know Tuesday will not be good, since you guys will be preparing for your AMP, I do not want to disturb you. So, but the next class that we meet will be our last class. The next class that we meet will be our last class for the module. All right. All right. Anything else before we dismiss each other?
James, sorry, well, for the next classes, I mean, can we also get the dates for economics and management as well?
Management, the last class is tonight at 7 o'clock. Economics,
marketing.
Marketing, you're supposed to meet on Monday for marketing. Monday is definitely for marketing. But I know you guys have got a lecture missing that you did not do. I know I sent you guys a video and whatnot, but you've got a lecture missing for marketing. But I will have to check, because I would rather we meet on Thursday for business finance, since business finance is your next module in terms of the exams. You would be stressed for business finance. So on Thursday, I would rather, you were supposed to do marketing on Thursday, but I would rather we meet for business finance. But on Monday, you are definitely meeting for marketing. On Monday, you are definitely meeting for marketing. But the other day for marketing next week, I will have to advise. I will just have to look at it.
So I think just to remember that we're writing business finance and economics in the same week. Eh?
All right, no problem. No, economics, you're still fine. Because remember, economics, we are meeting this Sunday, right? And then we are going to meet again next Sunday. So economics, we still have 2 more lectures that we are doing. So we are fine for economics. Then for business finance, we have 1 more lecture that we are doing this week on Thursday. Then for marketing, you're writing in December, so you still have time. But you are definitely meeting on Monday. But the other day for marketing, I will have to advise after we've seen how to schedule it out. But you still have at least 2 or 3 lectures for marketing. For business finance, 1 lecture is left on Thursday next week. For economics, 2 lectures are left. Sunday, this Sunday, and the next coming Sunday after this. For AMP,
All right.
1 lecture is left, which is tonight.
Okay, thank you.
All right, sure.
Hey, James, will you please just share the link of the recording in the group, please?
All right, sure, I'll do that.
Thank you.
Hey, thank you.
Sure, thank you.
James.
Thanks. Goodbye.
Bye-bye.
Thank you. Bye.
Thank you. Bye.